welcome back. You're watching Stockwatch with me, Juliette Televi, and joining me to take your stock-related questions this evening are Jean Pierre Verster from Protea Capital Management and Wayne McCurrie from FNB Wealth and Investments. If you'd like to send questions, please SMS 41392 or email stockwatch@bdtv.co.za. For the time being, we have only Jean Pierre on the screen with us, as Wayne is rather late this evening. Jean Pierre, nice to chat to you on a Wednesday night. It wasn't a particularly great day for the market, and I think there were two shares that maybe would have affected quite a few South Africans' portfolios, the decline of which would have done so, namely British American Tobacco and Sasol. If we can start with British American Tobacco, that's quite a thing to have a 10% decline on a share that size. But I guess inevitable when you take a $25 billion impairment against the value of your present assets.
Correct. Quite a number, 25 billion pounds.
Pounds, sorry. Pounds, yeah.
Write down like that and still continue doing business. But it is such a big company that they can. And they would, of course, tell you that it's a non-cash charge. So it's just an accounting entry. You debit the income statement and you credit the goodwill on the balance sheet, and poof, 25 billion pounds just goes away. And it has no cash effect. Now, that might be true, but the real cash effect was a couple of years ago when they bought the US business, the Lorry Lard business, and they effectively overpaid by 25 billion pounds. That is what is implied by the announcement today. So quite often when you get write-downs and it being non-cash, you need to go all the way back to the actual entries, the acquisition that caused these line items to find their way onto the balance sheet. And this is the consequence of overpaying years ago. So it does mean that going forward, the amortization of the remaining goodwill is actually less. So the forward earnings will actually be boosted by this write-down today. That's obvious. That's often called kitchen sinking.
Yes.
So they are kitchen sinking the results to some extent. But then it's not just accounting. The fact that the market looked at this and the shares were down almost 10% also means that people see that it is more difficult in the combustible cigarette market. The expectations are lower, and British American Tobacco have now said that they see a smoke-free future for them. They want the non-smoking part, still tobacco, still nicotine, but the more smokeless products, the new generation products, to be half of revenue by 2030. So that was the silver lining, but a lot to be concerned about. I think it's maybe a little bit of overreaction today, down 9%. But yes, quite a big move for a big share.
But Jean-Pierre, consistently the argument has been against, and so there's two schools of thought in the South African market. The one that posits that British American Tobacco, you get a big chunky dividend yield, it's a very stable business, it's got lots of cash on the books, and so that's a good thing. The other argument is that its business is dying, its people, its customers die as a result of its business, and now you're transitioning to a smokeless world. So actually, would you venture anywhere near British American Tobacco at this point in time? Given this...
So we do own it in the funds under our management. And what I would say is the positive about the smokeless future is you can get people hooked on a nicotine type substance without killing them. And that's brilliant. That's a brilliant business model. So I would love a company that can sell something that's addictive without them killing their customers. So it's a better business to be in new generation products versus actual cigarettes. And that's why I'm slightly positive on the future of British American Tobacco, especially at this valuation. Even though the cigarette business is dying, there's a new business growing, which is a better, more ethical business.
Wayne, good evening to you. Nice to see you there.
Yes,
yes, as you can hear, we're talking about British American Tobacco, which obviously had a fairly profound impact on the JSE today. So where would you stand at this point, having now seen what they've done with the impairment, what's happened to the share price? Would you abandon the stock, or would you actually buy more of it if you didn't actually have it?
Look, I mean, as JP said there, the move to vaping is actually quite positive. You go somewhere socially now, you don't see anyone smoking a cigarette, but there's lots of people vaping. There's actually lots of people vaping. The margins, I don't know. It's intensely competitive because you haven't really got a brand to fall back on, which you did with cigarettes. There was a brand you could fall back on, and there was a lot of value in that brand until they worked out that the market's disappearing quicker than what they thought, and then they write off 25 billion pounds against that, and they're still amortizing the other 50 billion pounds at 1.8 billion, whatever, per year that they're amortizing. And I must say, I find it a little bit annoying and it's not just British American tobacco, it's right across the whole industry, when people say, oh no, it's just a book entry.
Yes.
It's not a book entry. You paid up in real money for that. And now it's not worth what you paid for it. But I would be a little bit more, maybe circumspect. I think this, it's going to happen, but it's going to take longer than anticipated. Because you're not going to replace all of the tobacco smokers with the non-burn products now, the new age products. You're not going to replace them overnight. So you might still suffer some declining in your primary market before the other market takes off. On a 10-year view, I think the business strategy is sound. But in the interim, they've stated quite clearly they're spending big capex on this.
Yeah.
There's big cash going to be thrown at this one because you've got to build them in the cigarette brands that they own are, I don't know, 50 years old, 100 years old. Now you've got to build this brand new brand. And there are plenty of people in this market on the vaping side. I mean, I don't know how many competitors they got. So, it's an intensely competitive. In fact, in their statement, they actually moaned a little bit about the illegal trade or the unethical trade in the vaping side. So I think longer term, yes, but the shorter term, these transition points are quite difficult sometimes to manage. And also, I mean, they themselves say that it's not easy, they say.
No, indeed. Yes, it's wonderful. As Jean Pierre was saying, you can just, with a flick of a pen, make that bad money decision go away. Okay, well, talking about companies that have impaired things this year, Transaction Capital is one of them. And a viewer sends a question in saying, a shout out to Transaction Capital. The taxi industry is an extremely important industry and will continue to be so, especially in light of the collapse of rail infrastructure and I suppose the absence really of major bus services. I hold TCP shares. We Buy Cars and Newton are very good businesses. Do you foresee an unbundling of We Buy Cars and a listing of this unit, and would you be a buyer of the company's shares? Jean Pierre.
It was an interesting comment that was made at the results presentation that they are considering unbundling We Buy Cars. If they do get it right, I think it's one of the worst draftings of a lender agreement ever. If you're allowed to unbundle the most valuable part of a group while you leave the debt in the group and you effectively leave the debt holders with an empty shell. So that'd be very interesting if they get it right. If they do, kudos to them and well done for the negotiating in terms of the debt agreements they have. But I think it'll be more difficult than that. The positive is that most of the debt is ring-fenced within SA Taxi. There is some leakage into Newton and We Buy Cars. For instance, Newton mentioned in the results presentation that they are finding it difficult to get other lines of credit just because a sister subsidiary, SA Taxi, is under so much pressure. So there is some contagion, but it sounds like almost completely the debt is ring-fenced within SA Taxi. And the worst scenario would potentially be that SA Taxi goes bust, but that We Buy Cars and Newton survive. And that's not too bad for shareholders. Again, it's not great for debt holders, but if you're a shareholder, it's not quite as bad as what people thought it might have been. And then finally, you don't need the taxi industry to have a detriment if SA Taxi goes under. It just means that whoever lent the money to taxi owners will have a hard time getting the money back, or will have write-downs, will need to build new operational capacity. But the taxi industry will continue, but that does not necessarily mean that SA Taxi will survive.
Yeah. That's interesting. I mean, Wayne, as Jean-Pierre points out, it's not often that you have the debt holders who come after the shareholders. Normally, it's the shareholders who really get steamrolled by any major issue in the company. So that's quite a sort of a curious turn of events, really.
Look, they spoke extensively about, we've got our capital in SA Taxis, but there's no more. We've stated our commitment here, and reading between the lines there, it's up to the providers of debt to now make a plan to make sure the business carries on, etc., etc., etc. But I've my experience is that yes, legally the debt might be ring fenced, but You know, if you just stand back and say, well, we're walking away now, you take all the pain here, try and get some more debt, try and get financing somewhere else from anyone else in the industry. So, I mean, quite often what you find is, yes, legally it's ring fenced, but morally, if you stand behind these loans, the banks will come back and say, listen, you know, the only reason why we gave it to you was that, you know, you as shareholder of substance who stood behind these loans, so we expect you to make good. And if you don't make good, you know, that's it. You're not getting any more credit from us. And this is a very, very small community.
Yeah.
So, yeah, so I'm not sure whether they can just walk.
Okay, so
even though legally the debt is ring fenced.
And then onto the question though of would you buy We Buy Cars? I mean, Transaction Capital. You have actually seen the share price rally quite nicely, notwithstanding the kind of results that it put out. I mean, Coronation has upped its stake even further, so now they own more than 25% of the company, and that was announced on SENS today. Would either of you be a buyer? Wayne, maybe just sticking with you before I go back to you, Jean Pierre. You have said that you would buy Transaction Capital in the past. Would you continue now?
Yes, I have, and I was unfortunately dramatically wrong, because I thought to buy it after the first disastrous news came out, and then the second disastrous news comes out, and then the third disastrous news come out, and then the management's kicked out. But if you view this as a pure punt, as option money, in other words, double or zero, why not?
Okay. Jean Pierre?
Well, similar to Wayne, I was also a little bit early in buying, and I have been buying, but I kept on buying because I started relatively slowly. So I think the average in price for our funds is 10 Rand a share.
Okay.
It's now trading at 8 Rand a share. They're still 20% down, which isn't pleasant. But I also think there's the worst hasn't happened. And again, in the announcement, they say technically there was a cross default, but the lenders said they'll condone it to March. So there's a little bit of uncertainty left, but I'm still, I would say, a nervous holder at 8 Rand a share.
Okay. The viewer says it baffles me that analysts are baffled by Rand weakness. My thoughts, the JSE is to a large extent to play on China, and the Rand will struggle when China struggles. Think miners and Richemont as examples. Further reason for the Rand's woes: lackluster / pitiful economic growth, extreme levels of unemployment, increased offshore exposure from Reg 28, etc. As Rupert correctly points out, who wants to invest in a country that can't even produce enough electricity? With having said all of that, I see the Rand breaching 20 to the dollar within the next couple of months. Where does the panel see the Rand going? Wayne, do you think that bearishness is justified?
I mean, I bang this drum just about every day of my life. We all know the problems with South Africa. We all know the government, and we all know the electricity and Transnet and service delivery and inefficiencies and bribery and corruption, and none of that's new. But the biggest single negative influence on the Rand, well, the biggest single influence, either positive or negative, is still the commodity cycle. It has been for the last, 80 years since the discovery of gold and diamonds, 100 years. And now, of course, the commodities have changed, but we are still primarily a commodity producing country, and our positive and negatives on the Rand, on the economy, is still primarily driven by the commodity cycle. We're in a down cycle now. You can look at the price of platinum, palladium, iron ore, coal. The whole lot have collapsed. And what else do you expect other than bad news when that happens? Now, that cycle can turn. I think it will turn, because it's following absolutely normal patterns. So Rand weakness now is completely normal. There's nothing abnormal about the Rand weakness we're seeing now. But if that stays in case and the cycle turns, the Rand can appreciate 30, 40%, because it's done it every single other time. Remember the last time the Rand panicked, 2008, I think it hit 13 or 14. The next stop was 650.
Yeah.
Then you had the 2014, 2015, also got up to sort of 17, 18, somewhere around there. The next stop was 1350. The Rand can strengthen, and we are now evaluating the Rand and South Africa in the worst possible light at the bottom of a commodity cycle, and it can turn.
Yeah.
So if you want to panic, take your money out. Do it, but I think it's completely the wrong thing to do. You're panicking in a dire set of circumstances that by and large is cyclical, not structural.
Jean Pierre, I can't ask you for your thoughts on, I mean, it's hard to ask about your crystal ball forecasts, but based on all the facts that we have before us, do you think there is going to be a turn in the commodity cycle and ergo an improvement in the rand's fortunes in the next 6 months to a year?
Sure. So the issue I have with the question is the 6 months to a year part.
Yeah, 6 months.
I do think it's impossible to call within 6 months to a year. I agree with Wayne that anything can happen, including a strengthening of the rand. But that's why when it comes to currencies, notwithstanding that this is stock watch, not forex watch,
yes,
I look at the long-term interest rate differentials. And if you look at the typical SA government bonds, in dollars, they are yielding 9 to 10%, and US government bonds are yielding 4 to 5%. So that's called it a 5% interest rate differential. Over the long term, I would therefore expect the rand to weaken by roughly 5% per annum against the dollar. Not in a straight line, but that's what I expect over the long term. Now, to get from where we are now, just under 19 to 20, is 5%. So I would not be surprised if we are at 20 rand against the dollar in a year's time. But similarly, if the commodity cycle turns, and I have no idea if it will in the coming year, I would not be surprised if the rand strengthens. But over the long term, I would expect the rand to have a weakening trend against the dollar.
Okay. All right. Well, let's go back to stock watch, seeing as it's not forex watch. There is a question on from a young investor, and he says, this will be the 4th December that I buy shares or ETF for my teenagers of their choosing. My 16-year-old daughter, Kaylee, would like the panelist's opinion of a tech stock called Skyworks versus NVIDIA on the basis that Skyworks PE is 16 versus NVIDIA's plus minus 60, which makes it look expensive. Wayne, I don't know if you know of a company called Skyworks.
I don't know the company, so I can't comment on that, but I can comment about price earnings ratios and relatives. Just because one company's at 60 and the other's at 6 does not necessarily make the one cheap and the other one very expensive. If you are at a 60 price earnings, but you're doubling your 60 price earnings ratio, but you're doubling your earnings for the next 2 or 3 years, 60 is cheap. If you're at a 6 PE ratio, but your earnings are going backwards the next 2 or 3 years, the share is expensive. So whenever you evaluate a share, you must not evaluate it on the pure price earnings ratio, and I'll come back to that. You must evaluate it on the price earnings ratio relative to the expected earnings for at least the next 2 years.
Yeah.
If you take a company that has relatively stable earnings over a sustained time period, and it gets to a 6 PE where it normally trades as an 8, then you can say a 6 is cheap because it's normally an 8, and the company has proven that it's got relatively good earnings profile, etc., etc., etc. But you cannot just evaluate the price earnings ratio on its own. You've got to evaluate it relative to the expected earnings for the next 2 years, at least the next 2 years.
Okay. So that is very helpful stock market 101 information for any investor. Jean Pierre, do you know the company called Skyworks? And if you had to evaluate Skyworks versus NVIDIA, how would you stack them up?
So I looked at Skyworks a few years ago, and from what I remember, they make telecommunication chips, 5G chips. So their sales are very much linked to mobile handset sales, and the latest models would have the latest chips, 5G chips. So they would benefit from the latest mobile phones of Apple and Samsung and the rest. That is still a industry with less competitive advantage. It's more competitive than the industry that NVIDIA is in, which is a different kind of chip, a GPU, a graphic processing unit, which these days are not just used for graphics. It's the chosen chip for artificial intelligence as well. Now, I do think that the growth expectations for the AI industry, if you look at GPT and a few other things, ChatGPT, is much better than the growth of mobile handset sales. That's already a relatively mature industry worldwide. So notwithstanding the cheaper starting valuation, to Wayne's point, I would probably have a preference to NVIDIA. But then again, I do think that if the AI craze does not continue for, call it 4 years or longer, this high growth we are seeing, then NVIDIA's share price will also come down. So, there's a third option, and that is neither. So I'll go for that one.
Okay, that's really thrown the cat amongst the pigeons, but fair enough. Okay, a couple of very quick questions on two little South African shares. ArcelorMittal, good price now to buy. Wayne, do you think so, or is it just too much stacked against it?
No, I know the Arcelor share price has been very volatile and going up and going down, but no. The point is South Africa's steel demand has never been big enough to justify its own steel production. We just do not get the same economies of scale. You're just not making enough steel. So fundamentally, unless the government protects you and gives you protection, we shouldn't have a steel industry. It's just not big enough demand to get the volume through. You just can't compete against the big steel mills that are 50 times your size in output. So I wouldn't buy. I wouldn't buy it at all, and under no circumstances, quite frankly.
Yeah. I think we've got the ArcelorMittal international price there on the screen, not ArcelorMittal South Africa, but your point is taken. And Jean Pierre, if I may ask you a different stock before I get to your stock picks, Master Drilling. It's a company that's sort of grinding away. It's a very interesting company, but it sounds like you sort of feel like Master Drilling has never really met the promise that the market, that a lot of punters have attached to it. What's your thoughts about it now?
Agreed. So notwithstanding their drilling technology, which they say is a competitive advantage, the way that they drill from the bottom up rather than from the top down, I do think that, as you said earlier, we're in a negative commodity cycle. It's normally the type of capex that is spent very early in a cycle when new shafts are sunk, and therefore it'll be a long time before this commodity cycle gets back to the point where new shafts are sunk. So I'll be cautious. It's probably the best company in Vogel, but that doesn't necessarily mean you have to own it. There are other companies to consider as well.
Okay. All right. And I'm sorry, there were a few questions, one on Sasol, one on City Lodge AVI, but I don't have time for them, so hopefully Zanati will cover those tomorrow night. But I shall get your stock picks rather. Wayne, what takes your fancy at the moment?
Look, I'm going for property company Growthpoint. I've read now on many companies, many property companies, when they come out with their results now, the worst seems over for the industry. Office vacancies, even though they're still high, are actually going down. Negative rental reversions. In other words, when you sign a new lease, your actual price per square meter comes down. That negative reversion is still negative, but it's significantly less than what it was. Overall vacancies, are down, and you're getting half decent rental escalation in your new leases that you're signing. You're getting 5-6% rental escalations. And I mean, Growthpoint in particular, I'm only choosing Growthpoint because it's the biggest and probably the most well diversified, but you're getting a 12% starting dividend yield. I know you pay tax on it, but that just seems like reasonably good value to me in an industry that's maybe over the worst.
Yeah. Okay. Jean Pierre, and how about you?
My stock pick tonight is Life Healthcare Group. They have announced the sale of AMG that should be wrapped up early next year. And with that cash in the bank, shareholders can look forward to a special dividend of between R4 and R5 a share. That's what's expected. And what you're then left with is a South African hospital group. And let's be honest, the South African hospital industry isn't too exciting. And Life Healthcare hasn't really shown positive operating gearing. So that's a bit disappointing. But the other part of the business that you'll get is also Life Molecular Imaging, where they sell what is called a tracer, a radioactive agent that assists in when scans are done, specifically in the US through new technology for Alzheimer's, and a new drug that is being used for Alzheimer's in the US. So the expectation is that LMI will grow strongly in the next 2 to 3 years, while the SA hospital business will at least be stable. And notwithstanding NHI, and I see it's been passed through the National Council of Provinces tonight. It's not quite as bad for hospital groups as it is for insurers, and I'm sure there'll be a lot of legal challenges as well. So Life Healthcare is not too badly placed in South Africa with their hospital service, plus the upside from LMI. plus a special dividend on its way. So that's my stock pick tonight.
Okay, gents, we shall leave it there. Thank you very much for all the wisdom that you have shared with us this evening. Much appreciated. Jean Pierre Verster is from Protea Capital Management. Wayne McCurrie is from FNB Wealth Investments. And coming up next, the close. Stay with us.